welcome to the Jack and Bill Show. You have Bill today. Jack is out, so I'm manning the fort. And it's been an interesting week. There has been so much going on. The biggest news has certainly been GameStop and the huge volatility that we've witnessed in that stock price. Also, the news surrounding the action. It's been something just, it's an amazement. And there are a lot of issues surrounding this phenomenon, and something that we have posted about this week, and I encourage you to look at those posts. And if you have any questions, reach out to us. We have been fielding questions from clients about what's going on and why. But perhaps the most intriguing question that I have fielded this week is this: could the volatility that we've been witnessing in GameStop be the catalyst for a market sell-off? And there has been a lot discussed in recent months about the markets being in a bubble and just how long this bull market can run. So I want to really just spend today talking about market bubbles and just give you, some things to consider. I can't say if we're in a market bubble. I can't say for sure that one is upon us, that we're in it, or it's going to end. No one knows that with any kind of clarity. But I do want to kind of help guide you in your assessment, and you can decide for yourself. So for starters, what is a bubble? There is not a universal definition, for market bubble, but it is a condition or a situation where the market or a security specifically is priced way much higher than the underlying valuation, and certainly it's moved way above the trend line. Now there are some symptoms of bubbles, that we can look for. One of those is easy money, also known as excess liquidity. Excessive valuations is certainly one of the indicators of a bubble. Exciting narratives, right? The stories, that get everyone all excited and worked up about investing. And lastly, extreme optimism, or what we in the industry call irrational exuberance. You get into a situation where the optimism is so great, no one's paying attention to fundamentals and valuations, and people are investing not because the investment thesis necessarily. They're investing because there is this notion that there is someone else out there. It's called the greater fool theory, that no matter what you pay for security, there's a greater fool out there that you can sell it to. So how would we assess today's market against those symptoms? We'll just go down the list. Easy money, check. Definitely have easy money. We've seen an explosion in the money supply. The Fed has been pumping $120 billion per month into the financial system through quantitative easing programs. We're at 0% Fed funds rate, and they have stated publicly that they're likely to keep it there for years. And the Fed funds rate is the benchmark against which all short-term interest rates are pegged. And that's why you can't make any money putting money in the bank or buying CDs. That's why margin interest rates are so low. Money market funds aren't paying anything. It's because the Fed funds rate is pegged at 0. Also, we have this combined monetary policy and fiscal policy stimulus. That is very rare to see these two working in concert. And that's something we talked about last week, the notion of the helicopter money, the easy money. That's certainly at play. And so the result of this is, one, there is no alternative. So if someone is traditionally invested in high quality bonds, or if their money is in the bank and in CDs, they're making nothing. And after accounting for inflation, they're making less than nothing. So for those reasons, it is forcing people into risk assets because there is no alternative to make a return on their money. And I did mention margin interest rates. With interest rates this low, it is incentivizing people to take more risk with their investment strategy by investing on margin. So basically borrowing from the brokerage firm and using the borrowed funds to invest more money. All right, what about excessive valuations? Check. Right now the S&P 500 trailing PE is at 41. That's very high. It was 26 a year ago, and the historical average is less than 20. We've never seen the trailing PE ratio for U.S. median stocks any higher than it is right now. Now there's other things that we use to assess valuation, and there are a number of Wall Street firms that have proprietary measures. Goldman Sachs, for one, has a valuation index that they utilize, and they're looking at a number of factors: market cap to GDP, enterprise value to sales, enterprise value to EBITDA, forward PE, cash flow yields, price to book, cyclically adjusted PEs, and there are other things as well. But the conclusion, looking at the basket of those valuation metrics, is that the broad market is at or near its most expensive level in recent history. That's just where we are. There's the Buffett indicator. That's a measure popularized by Warren Buffett. It's the total stock market capitalization to gross domestic product, and it broke through its all-time year 2000 high. So check on excessive valuations. All right, what about the narratives? Do we have exciting narratives in the marketplace? Check. We sure do. I think one of the biggest ones is disruptive technology. And we have certainly seen exciting narratives around things like the Internet of Things, AI, blockchain, 3D printing, and the list goes on. There are some very exciting narratives that people are attracted to. All right, what about irrational investor behavior? Check, especially on the part of individuals. Look at GameStop, what's been happening this year. You know, for a stock to go up, a junk stock at that, that's probably valued at less than $15 a share, to increase 1,700% in less than a month, that's irrational. Look at Bitcoin, the movement in Bitcoin. What about Tesla, a company that's barely profitable? Its market cap is larger than 12 global auto companies who sold a combined 44 million units last year compared to Tesla's 400,000 units in sales last year. Here's another one, SPACs, special purpose acquisition companies. These are blank check companies, no operations. They're raising money through IPOs to use for whatever purpose they want. To me, that's irrational. Some may disagree. All right, so you take all of these things and combined, I would describe it as a situation of fear of missing out. And sadly, we see individual investors getting in at the end of bull markets. And it's greed. That's really what fear of missing out involves. And at the end of bull markets, it's very common to see rapid price movements. And these individual investors get sucked in right at the top. There is a gauge that the Citigroup chief U.S. equity strategist Tobias Levkovich follows, and it's called the panic to euphoria gauge. So he's using a proprietary mix of measures, and it does help evaluate just how much euphoria or irrational exuberance is in the market. So looking at components such as the short interest ratio, margin debt, trading volumes, bullishness, put call ratios, and other things. Right now, this ratio is way out of whack, indicative of irrational exuberance. Look at the outperformance of junk stocks. Okay, so certainly GameStop is one of those. But specifically, there is an index, a proprietary index managed by Goldman Sachs. It's called the Non-Profitable Technology Index. This is an index of tech stocks and innovative industries that have yet to turn a profit. That index has gone straight up since March of last year. Now, so I've given you reasons why many believe that we are in a bubble, but we also need to consider the other side. So, on the other hand, we are in this low interest rate environment that continues to fuel demand for stocks, and that makes stocks inexpensive relative to bonds. So, U.S. stocks are only inexpensive relative to the bond market. We're also seeing an economic reopening. There's low earnings expectations because of the pandemic shutdown. So as the economy opens up, we could certainly see more economic activity. And with the stimulus, fiscal stimulus coming through, we could certainly expect that. That could keep this thing going for longer. And there's still plenty of cash. Anecdotally, we read about that. So I guess I would just say that the picture is more nuanced. It's not so black and white. I mean, frankly, bubble spotting is very difficult. It's very, very difficult. It's hard to even know when you're in one. It's like a frog in boiling water. You just don't really know. And these valuation tools that we have at our disposal, they are useful, but they're not good market timing tools, because we know that the market can go in an overextended valuation phase for much longer than we think it should. So the markets, consider this. Markets are made up of people, and people are not rational. So we have to consider the behavioral aspects of market participants. There's also a lot of noise out there. Wall Street has a habit of getting people in when they at the worst possible times and keeping them sucked in. That's part of it. But there are also people who want to make a name for themselves. There are people out there who are very strongly claiming that we are in imminent bubble bursting. Maybe we are, but you have to consider the motives of the people saying that. And some of the people saying that are saying that to motivate you to buy things, like precious metals, for example. We see that a lot. There are also people out there saying this just because they want to make a name for themselves, so they can say, "Look, I told you so." I've made a name for myself calling the 2008 bubble, so I have a track record, and I'm calling it again. That happens. I'll leave you with this. As the saying goes, there is nothing new under the sun. And that is certainly the case today. The narratives change, the players change, but the underlying elements are always the same. And it's fear and greed. We've been through bubbles before. We saw a big bubble in the Japanese stock market. More recently, we had the tech bubble in the late 90s. And when that bubble burst, we saw the NASDAQ decline 82%. But you know what? Before it burst, everyone thought they were an investing genius. Everyone was throwing out stock ideas. You couldn't lose money. That's how crazy it was at the time. And then more recently, we had the housing bubble. So the 2008 credit crisis, which followed a housing bubble, and people were doing crazy things with houses, basically using their house as an ATM, buying multiple homes that they couldn't afford, overly levered. Okay, it's like we never learn our lesson. And we may be in another bubble today. We don't know. But I'll say this. Greed is not good, okay? In spite of the famous movie line, greed is not good when it comes to investing. Neither is fear good when it comes to investing. But we humans, as emotional creatures, were not wired to be good investors. So when we're making investment decisions, we don't want to be led by our emotions. It's so important that we be grounded in these decisions. But anyway, those are my thoughts. Like I said at the beginning, I'm not prepared to say if we are or if we aren't, but I did want to educate. Hopefully, everyone got something out of this. Have a great day, a great weekend, and we'll see you next week.